Every business has a structure that determines its operation and how the government will recognize it as a legal entity. Different business structures offer different benefits and restrictions, so it's essential to understand what's at stake in how you organize your business. A corporation is an independent business entity that is separate and distinct from its owners, which are known as shareholders. Once incorporated, the company exists as its own entity in perpetuity, even as shareholders come and go. And unlike sole proprietorships, partnerships, or LLCs, these owners often have little or no role in everyday business functions, though it is possible to own and operate a corporation as a single shareholder. If you're planning on forming a corporation, you should also be aware of the different types of corporations. A C Corp is the default structure when forming a corporation, which is, again, a distinct business entity owned by shareholders. As a distinct entity, it must pay corporate taxes separate from the tax burdens of its owners. An S Corp is a corporate structure that has many of the same features as C Corps, but when it comes to taxation, it qualifies as a pass-through entity. Corporations must meet particular IRS standards to be recognized as an S corporation, but once a business makes that election, it means profits will pass through, avoiding most corporate level taxes and only be taxed on the owner's personal tax returns. S Corp status is intended for small, closely held corporations, and so are required to have no more than 100 shareholders, no non-resident shareholders, and only one class of stock. Whether or not a corporation is recognized as a C Corp or S Corp, there are a number of similarities between these corporate structures. Since S Corps start by incorporating as a C Corp, the formation process is largely the same. It will require registering a business name, appointing a registered agent, filing articles of incorporation, selecting an initial board of directors, drafting corporate bylaws, and issuing stock. The exact process will depend on the state, but any corporation will go through the same initial steps. Once established as a C Corp, an entity that meets the requirements can then elect to be taxed as an S Corp by filing with the IRS and their state collection agency. In select states, an S Corp won't be treated any differently than a C Corp, but will have the benefit of pass-through taxation at the federal level. By incorporating your business as a separate legal entity, that means the shareholders have limited liability for the company's debts and litigation against it. Their personal assets can't be taken to satisfy creditors or legal judgments. This applies whether the company is a C Corp or an S Corp. Corporations have to adhere to administrative requirements for how the company is directed and controlled. These vary by state but are the same whether the corporation is a C Corp or S Corp. Generally, there are corporate obligations that involve adopting bylaws, filing annual reports, and holding shareholder and director meetings. While similar in many ways, S Corp status aims to support small business corporations, primarily with federal tax obligations. Here are some of the fundamental ways the two structures differ. A C Corp is effectively taxed twice on the same income, once at the corporate level according to the corporate tax rate, and again as the profits are distributed to individual owners and employees. S corporations allow pass-through taxation to avoid having your business taxed at the corporate level. Owners instead claim all of a company's income on their personal tax returns. However, depending on where the company is incorporated, S Corps may still have to pay state-level corporate taxes or franchise fees, though often at a lower rate than C Corps. Any corporate shareholder will have to pay taxes on income they receive through the corporation, whether it's an S Corp or a C Corp. But because an S Corp is a pass-through entity, all profits have to be allocated to shareholders at the end of the tax year. Even if the profits functionally remain within the company, they must be claimed on a shareholder's personal tax return. Profit can be distributed however the company has agreed to distribute it, but it must all be accounted for. For the C Corp, however, there are more options for how to handle profit distribution. Corporation leadership can decide to retain profits or use it however they like. The most common avenue for distributing profit to owners is through dividends. Owners of an S Corp who are involved in the operation of the company must also pay themselves a reasonable salary commensurate to their role, experience, and industry standards. Shareholders who provide services to a C Corp can pay themselves little to no salary and compensate themselves entirely with profit distributions. If C Corp shareholders do take a salary, that can be deducted from corporate revenue, while because an S Corp is pass-through, shareholder salaries can't be deducted. Ownership works similarly for both C Corps and S Corps. The corporation owners are not necessarily those responsible for any regular business operations, but those who own stock in the company. The corporation reduces private liability for any debts or losses this way. However, as S Corps are designated for small businesses, there are restrictions on ownership in order to qualify, such as having no more than 100 shareholders and only one class of stock. Shareholders also cannot include partnerships, corporations, or non-resident shareholders. The ability to have unlimited shareholders and different classes of stock makes it easier for C Corps to attract a wide variety of investors. However, it is simple to change status as your company grows. As an S Corp, you can always revert to a C Corporation to achieve greater growth. Beyond the rules related to shareholders, there are other restrictions that limit the type of company that can elect to be an S Corp. S corporations must be domestic U.S. corporations, and some businesses operating in certain industries, like insurance companies or certain financial institutions, are not eligible for S Corp status either. If you're uncertain about any of these important business decisions or want to help with the planning and paperwork, consider working with an accountant. Accountants can help small businesses succeed and get ahead of the competition. It can take a lot of time and effort to ensure you've chosen the most efficient business entity and are fully compliant with all the laws governing your tax status. Work with the experts at 1-800-ACCOUNTANT who can help you through the process. As always, thank you for watching, and if you found this to be educational or informative, helpful or entertaining, please like and subscribe and look for 1-800-ACCOUNTANT on your social media channel of choice.